Hey hustlers, Ranveer here. Welcome to another episode where we dive deep into the world of finance. Let's talk about money, specifically making your money work for you. It's not just about earning, it's about smartly managing and growing it. We all want financial security, that feeling of knowing our future is bright and secure. The key to achieving this? Smart investments. It's not just about saving, it's about growing your wealth over time. Think of it as planting seeds that will grow into a bountiful harvest. Think of it like building a fortress, a strong financial fortress that can withstand any storm. You need strong, reliable bricks. Each brick represents a smart financial decision. That's where smart investments come in. They are the foundation of your financial fortress. They are the building blocks of your financial future. Each investment adds strength and stability. Two popular options often pop up: fixed deposits, FDs, and mutual funds. Both are essential tools in your investment toolkit. Both have their pros and cons, and understanding them is crucial. It's about finding the right balance for your needs. In this breakdown, we'll dive deep into FDs and mutual funds, comparing them head to head. We'll look at their benefits, risks, and potential returns. We'll use simple terms, no financial jargon here. We want you to feel confident and informed. By the end, you'll clearly understand which investment path aligns better with your financial goals. You'll be ready to make informed decisions. Stay tuned. There's a surprise waiting for you at the end, a chance to grab a reward worth 21,000 rupees. Don't miss out on this exciting opportunity. Let's start with fixed deposits, often considered the safe haven of investments. They're like that reliable friend, always there for you. With an FD, you deposit a fixed amount with a bank or financial institution for a specific period. This period can range from a few months to several years. The best part? Guaranteed returns. You know exactly how much interest you'll earn upfront. This makes FDs predictable and excellent for conservative investors or those who prioritize capital protection. However, this predictability comes at a cost. FD interest rates are generally lower than potential returns from other investment avenues. Remember, while FDs offer stability, the returns might not outpace inflation in the long run. This means the purchasing power of your money might erode over time. Now, let's dive into the world of mutual funds and understand how they work. Imagine a pool of money contributed by several investors, just like you. This collective investment is what forms the basis of a mutual fund. This pool is then invested in a diversified portfolio of assets like stocks, bonds, or a mix of both. Diversification helps in spreading the risk and potentially enhancing returns. Think of a mutual fund as a vehicle that allows you to participate in the stock market's growth potential without directly investing in individual stocks. It's like having a professional driver navigate the financial roads for you. Mutual funds are managed by professional fund managers who have the expertise and experience to make informed investment choices. These experts make investment decisions on your behalf, aiming to generate the best possible returns by analyzing market trends and economic indicators. The exciting part? Mutual funds have the potential for higher returns compared to traditional fixed deposits, offering you a chance to grow your wealth. However, it's essential to remember that mutual funds are linked to market performance, which can be unpredictable. This means when the market is doing well, your investments can grow significantly, providing substantial gains. But when the market experiences downturns, your investments can also lose value, highlighting the importance of understanding the risks involved. Let's make this comparison crystal clear with an example. Imagine you have 1 lakh rupees to invest. You could choose a fixed deposit with a 6% annual interest rate. After 5 years, your investment would grow to approximately 1,33,822 rupees. Now, let's consider a mutual fund with an average return of 12% per year. While this return isn't guaranteed, we'll use it for our illustration. With the same investment amount and period, your money could potentially grow to around 1,76,234 rupees. This example highlights the potential of mutual funds to outpace FDs in terms of returns. However, It's crucial to remember that mutual fund returns are not fixed or guaranteed. They are subject to market fluctuations. Section 5. Risk versus reward. Finding your investment sweet spot. The age-old wisdom holds true. Higher potential rewards often come with higher risks. This principle is fundamental in the world of investments. Fixed deposits, with their guaranteed returns, are considered low-risk investments. They provide a sense of security and predictability. They are like the steady tortoise in the race, slow and steady. Over time, they can help you build a solid financial foundation. Mutual funds, on the other hand, offer the potential for higher returns but also carry a higher risk. They are more dynamic and can adapt to market changes. They are like the hare, capable of swift progress but also susceptible to sudden pauses. This can lead to significant gains or unexpected losses. So, how do you choose the right investment path for yourself? It requires careful consideration and planning. The answer lies in understanding your risk appetite and investment goals. Assessing your financial situation and future needs is crucial. If you're someone who prioritizes capital protection and prefers guaranteed returns, fixed deposits might be a good fit. They offer peace of mind and stability. However, if you're willing to embrace some risk for the opportunity to earn potentially higher returns, mutual funds could be an avenue to explore. They offer the excitement of growth and the potential for substantial financial rewards. Section 6. Mutual funds. Navigating the risk minefield. Now, let's address the elephant in the room when it comes to mutual funds. Risk. Yes, mutual funds are inherently riskier than FDs. But here's the thing, not all mutual funds are created equal. Just like you wouldn't jump into a car without knowing how to drive, you shouldn't invest in mutual funds without understanding the different types and their associated risks. There are various types of mutual funds, each with its risk profile. Some funds invest in low-risk assets like government bonds, while others focus on high-growth, high-risk stocks. The key takeaway? Diversification. By spreading your investments across different asset classes and sectors, you can mitigate risk and potentially enhance returns. Remember, investing is a marathon, not a sprint. Section 7. The power of compounding. Your money's secret weapon. One incredible advantage of starting your investment journey early is harnessing the magic of compounding. Think of it as a snowball effect. When you reinvest your earnings, those earnings in turn generate more earnings. It's like your money is working overtime for you. The earlier you start, the more time your investments have to compound and grow exponentially. Even small contributions made consistently over time can lead to significant wealth accumulation in the long run. Remember, the journey of 1,000 miles begins with a single step. So, take that first step today. Start investing early and watch your money grow exponentially over time. Section 8. Your financial journey. Taking the first step. Choosing between fixed deposits and mutual funds isn't about finding the right answer. It's about finding the right fit for your unique financial goals and risk appetite. Before making any investment decisions, it's crucial to do your research, assess your risk tolerance, and consider your investment horizon. If you're unsure where to start, seeking advice from a qualified financial advisor is always a wise move. They can provide personalized guidance based on your circumstances and help you make informed investment choices. Remember, investing is a journey, not a destination. It's about making consistent efforts over time to build a secure and prosperous future. Section 9. Unlock your financial toolkit. 10 free calculators await. Hey, you've made it this far. As promised, here's a little something to empower you on your financial journey. I'm giving away 10 powerful financial calculators absolutely free. These calculators will help you make smarter investment decisions, plan your finances effectively, and achieve your financial goals faster. To claim your free calculators, it's simple. 1. Take a screenshot of this essay right now. 2. Share the screenshot on WhatsApp with your friend. Spread the knowledge. 3. Send the screenshot you took to WhatsApp number. That's it. Our team will send you the link to download your 10 free financial calculators. Section 10. Your path to financial freedom starts now. Investing is one of the most powerful tools we have for building a secure and fulfilling future. Whether you choose the steady path of fixed deposits or the potentially more rewarding route of mutual funds, remember that the key is to start early, invest consistently, and stay informed. Your financial journey is yours to create. Take charge, make informed decisions, and watch your financial dreams turn into reality. Until next time, keep hustling and keep investing in yourself.